There's different ways of approaching that. Okay, so the first thing we need to do is look at the universe of the companies and find out, do they have capital structures that combine bonds or just equity, or equity and bonds combined. We need to look at a pricing of those securities, and then we need to look at the assets to be able to determine what is collateralizing the value of those bonds and those equities. Is it at a sufficient discount? Then we need to determine, is there going to be a change in the supply and demand of whatever product that they sell, whether it's metallurgical coal, or it's thermal coal, or it's gold, or it's silver, or in the case of the semiconductor industries, it was DRAM prices, direct random access memory prices. And once you can determine that the variables are in place, a change in the supply and demand where you know you're going to straight or righten the ship up, then you can sort through the various companies. And in many cases, with certain industries that are so depressed, you might want to look at the bond capital structure first, where you've got debt that's now junk bonds or high-yielding securities, where they have the first clam on those assets. Because sometimes the fairy dust of this business is recognizing the amount of time it's going to take between where you think things should be getting fixed and where they actually do get fixed. And if you're carrying bond capitals, bond interest, you're paying that freight along the way. So a lot of times we'll roll into a high yield debt security, even maybe a bank debt security first. And then as things improve and we can see changes in their cash flows, changes in their revenues, we'll roll up the capital structure into their equities. And that way we have a long runway and we have a really good foundation of information with the management teams, as well as what the assets look like and the direction of the industry.